This video is about how to build a bulletproof portfolio. We're going to cover 5 concepts that help you create a portfolio instead of holding a collection of coins. Let's get into it. On January 21st, 2022, Bitcoin closed at around $36,500, down 50% from its November high. Ethereum was also down 49%, Solana 65%. The drawdown isn't the interesting part. Who survived it is. People think they're diversified because they hold 15 different assets across sectors, narratives, and chains, yet these same people were down almost as much as those holding Bitcoin alone, and in some cases even further down. They were confident they were diversified, but that diversification they thought they had was an illusion. Today, as part of our portfolio construction episode, we're going to answer the architectural question under every single portfolio. Not what to hold, but how to hold it. Let's walk through how successful investors and institutional players actually frame portfolio construction. The first thing that distinguishes a constructed portfolio from a collection of coins is tiering by conviction. There's a popular framework used by many sophisticated investors that breaks holdings down into 3 different baskets: core, satellite, and speculative. Core positions are held for a full cycle, perhaps longer. Conviction structural, the thesis is durable, sizing is meaningful. Perhaps 60 to 75% of the total portfolio. They're the most liquid, established assets in the market. Satellite positions have a clear thesis, a defined time horizon, and a clear invalidation. These are things such as layer 1s, established protocols, and infrastructure plays. Conviction's high, but not structural. Sizing's moderate, maybe 15 to 30%. Speculative plays are asymmetric bets. These are new launches, narrative plays, and swing trades. Positions are sized as if the position went to 0, it wouldn't hurt the balance sheet. Maybe 5 to 10%. The weights aren't the point. The point is that every position has a category, and every category has rules. Can you articulate every category each position you hold sits in? Do you know the maximum acceptable size for any position? And under what circumstances would that change? If you can't, then you don't have a portfolio. You have a collection of coins. And now you have to change that. An important caveat worth understanding is sometimes you may have a satellite position, it outperforms gradually, and the next thing you know, sizing creeps up. Conviction inflates retroactively to support the position. And by the time the cycle turns, that 5% satellite position now sits at 18% core. The issue is that all of the work that goes into coming up with a strong conviction for a core position was skipped over simply for performance. Watch out for this. We'll cover rebalancing shortly. The next stage when constructing a portfolio is to understand market cycles. There are 4 phases to market cycles. First, accumulation. This is the period after capitulation, when prices are flat and sentiment is dead. Then you have markup. This is the trending bull. Then we have the distribution phase, where everything starts to top off. Lastly, we have the markdown, which is basically the bear. In accumulation, big players are accumulating core positions. Structural exposure is being increased. In markup, the satellite tier expands. Higher beta exposure outperforms, a speculative liquidity flows in. This is where altcoins perform. In distribution, the satellite and speculative tiers compress. Investors sell beta into strength and rotate back to core. In markdown, the speculative tier goes almost to 0. What survives is core, cash, and patience. Picture this, it's January 2021. You have a portfolio with a 70-25-5% split across core, satellite, and speculative. As the markup phase progresses, the satellite tier starts to outperform and appreciate. By mid-year, weights have shifted to 60-35-5. A passive holder rides this drift, but a disciplined allocator, those who succeed most in crypto, rebalances. The disciplined investor misses out on the last few months of the bull market. However, he does dramatically better through the subsequent bear market. Why? Because the rebalancing pulled the risk off of the table. Circling back to diversification, in quiet markets, crypto looks diversified. Bitcoin in a basket of altcoins may have a 30-day rolling correlation of 0.5 or 0.6. However, in stress markets, those correlations collapse to almost 1. Every chart looks the same. The diversification you thought you had was not there when you needed it most. The top 20 assets versus Bitcoin has historically averaged around 0.55 in calm times, went all the way to 0.9 in stress times. In short, being diversified is very helpful in bull markets. Exposure to alts allows for outperformance. However, that diversification becomes obsolete in bears.